again and welcome. This is Robert Schein, Managing Director and Partner of Blanke Schein Wealth Management. Happy New Year, and thank you for joining us for our first video version of our market insights and observations of 2023 from our new podcast studio, video studio of all sorts. We're going to be doing a lot of content from our new location here in Palm Desert, California. So if you're a client, we're looking forward to showing it off in person very soon. We got a lot of things that we're still settling in terms of a lot of the interior design and stuff. All of that fun stuff is being taken care of over time. We'll get there, but we'll send an announcement and have a wonderful open house. In the meantime, business as usual. And as we start off the new year, we have a new Congress. Let's talk about the three things that we're paying attention to as markets are, so you should be too. And again, these are educational based, and they're an opportunity for you to get an insight as to what our thinking is, our portfolio positioning, and more importantly, what we really want you to pay attention to as a client, as a friend, or just somebody in the community that's been a wonderful supporter of our broadcast, if you will, for the last few years. And it's growing a community. And again, it's free. Just like and subscribe. If there's somebody that you want to add, let us know. We're happy to add them too on a daily distribution list, or when we have our on-demand special events as well. We're happy to do so. But again, new Congress, new year. And as what we discussed in our old sort of previous earlier last year insights and observations, it's almost like a harken back to our deja vu of 1994. I really discussed this, which is back then you had all three branches of government, the House, the Senate, as well as the presidency, with one party holding power at the time, and that were the Democrats at the time. And again, 94, you have the House then flipped over Republican, and Newt Gingrich became the Speaker of the House, which essentially just created a divided Congress. In fact, what we saw just play out most recently in November, and obviously since January 3rd, a lot of ducks had to get in a row in Congress as they essentially did all their horse trading behind the scenes. But the take-home point, like in 94, like it is in 2023, again, gridlock. And that's a good thing, because right now, I don't know that we need any more fiscal spending from coming from Congress. They got another $2 trillion, just less than $2 trillion bill in at the year end, and it's coming off the last 2 or 3 years. Ultimately, that's really what's driving sort of the inflation issues that the Federal Reserve is talking about. And the Federal Reserve, essentially, Jerome Powell kicked off the new year to this morning in one of his speeches, talking about how he's going to remain hawkish. Again, it's another theme or sort of indication that every time I've been speaking within the press, if you will, or some of my media hits, or even one-on-one with our clients, Jerome Powell does not have the luxury of taking his foot off the pedal. He has to go all in on terms of being hawkish, all in terms of increasing the terminal rate, if you will, the Fed funds rate, and keeping it higher than the inflation rate. And right now, that's inverted, just like the 10-year Treasury has been inverted, just like we've seen. There's a recessionary indicator on the horizon, according to the yield curve. But in the meantime, the Federal Reserve Chairman doesn't care, because if he takes his foot off the gas pedal, if he becomes from hawkish to dovish, he then allows inflation to, again, like in the late 70s, they don't want to have policy error that they did in the late 70s, again, represent itself. And that's essentially one of the biggest risks for 2023 is a policy error by the Federal Reserve. So Jerome Powell is going to remain hawkish. He's going to continue the cadence of interest rates. But if you look at what the markets are actually showing us and telling us, and this is why we sort of take special note, we saw the U.S. dollar. If you talk about the U.S. dollar strength, this is all in 2022. You're seeing the U.S. dollar strength right here. All of last year was based upon interest rates. Interest rates were being obviously on the march higher, and therefore you're seeing a stronger dollar as a result. Now, you're seeing this inflection point right here, and now a downtrend has persisted. And now we're looking at from the 115 high to 105 right now in the US dollar. It's come off of the strength from last year and actually broke below the 50-day moving average. And from a technical standpoint, once it breaks below a moving average, such as the 50-day as it did most recently, that becomes the new sort of ceiling. So the 105 mark for the dollar is going to be very important. And that means that the dollar could be predicting that the Federal Reserve could be slowing their interest rate policy, meaning it's not going to be so supportive of interest rates. At some point in time, that's going to bring back the dollar, and we're already seeing that being predicted in the markets as they're being played out. Now, how do we position our portfolios as a result? Well, if the dollar then trend continues weaker, we like international, we like emerging markets, and you can see that continue to increase in terms of exposure in our portfolios. Now, right now, we're going to kick off the earnings season later this week. The big banks on Friday talk about, all about their earnings and how they ended the year 2022. And we know that earnings ended in a downtrend, even earnings growth, but there was still earnings growth last year. And what's more remarkable right now is their consensus on Wall Street for earnings growth for this year, 2023. Right now, we could see in the blue line right now is about just under $200, $220, 219 right now is the where we could see the S&P earnings finish up. Again, we're in the reporting season this first quarter this year. For the next month and a half, we're going to see where we do, how corporations actually end up. But this red dotted line right here is showing the 229 estimate for what earnings could be for the S&P 500. What's interesting is that we've got earnings growth that's being projected and predicted by the consensus on Wall Street. How is that possible if we're entering into a recession? There's a lot of recessionary indicators, a lot of recessionary calls, but this is very interesting. We're going to see where we are. If we do get and maintain earnings growth, we could see markets end up higher at the end of 2023. That's what we're really, our base case is and our thinking is, because if you think about it, on this chart, this is just showing the last, going back to 2021 at the very beginning, where earnings have been, how sales have really played out for S&P 500, as well as margins. And the margins are these blue diamonds. So margins have now been compressed. They're actually in a downtrend going the last 4 quarters of last year. And we see an inflection point right here. So from the fourth quarter to the first quarter, this is going to be very interesting to see if there's margin expansionary or multiple expansion and margins continue to improve for corporate America. That could happen in the back half of this year, because right now we're looking at this consolidation pattern for earnings, and margin expansion could happen. That means higher equity prices from current present levels if this holds and if in the 10-year Treasury stays where it is. If interest rates continue to go higher, and the higher interest rates go, the lower the multiples come down, or the valuations for earnings as well as corporations. So this is going to be played out, but 2023 could be that year where we see a return to earnings per share growth again, and margin expansion, if you will. So that's interesting. It's one thing we're going to be paying attention to, as you should be. Again, like and subscribe, share. That's our update for today, our first video version of our market insights and observations today in our new studio in Palm Desert, California. Thanks for watching, and I will see you again later this week. Take care.